Before we start, Andy, I just wanted to say a quick thank you to our podcast sponsors, Money Farm. Now, Money Farm are the largest digital wealth manager in Europe, and they create portfolios of ETFs for their clients. They're incredibly cheap and ideal for somebody who's wanting to get into investing, and perhaps for more experienced investors who don't actually want to run their own money anymore. Now, they will even offer to run the first £20,000 of any of our listeners' portfolio absolutely free if they enter the code MTTM20K into the website at moneyfarm.com. For more information, check out their website. But for now, Andy, let's get back on with the show.
Hello and welcome to episode 174 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leeks. Damien, good to see you back. How are you doing?
Oh, good, Andy. It's good to see you. I'm admiring the beard. Just prior to us coming on air, I was admiring Andy's full beard that's growing. How long is it now, Andy?
It's been about 3 weeks, I suppose, 3.5 weeks.
Yeah, and as a man who could probably grow a beard overnight, it is looking particularly impressive. So it's a shame that people can't see us. We will do the Facebook Live at some point, and then we can all admire Andy's beautiful beard. But
I'll tell you what, I'll do a deal. I'll keep the beard. I'm not sure whether the beard is staying or not, but I'll keep the beard until we successfully do a Facebook Live. So there we go. That's a challenge.
So you're like one of those footballers who refuses to cut his hair until he scores a goal.
Yeah, that's it.
Yeah, there was a Spurs player who famously did that. So yeah, has your week been good?
Yeah, it's been good. I've been busy at work. The children have enjoyed the Easter break. They're just enjoying the last few days. So yeah, just getting on with it really. It's good fun. You been up to much?
Well, a similar mix really. Bit of Easter break with the kids. But I've been doing a lot behind the scenes on Money to the Masses, because quite interesting for people who listen to this podcast, I suppose. They hear this podcast, they will read our content, so they will view it as something that's very much, we produce content and push stuff out there. And that is a big part of what makes Money to the Masses what it is. But there's also the business element behind it. So as a business, I had a lot of meetings this week. I was up in London, up and down the trains. If you'd caught a train from Kent, you had a chance of bumping into me. So yeah, I've been doing a lot of that, which is sometimes quite nice because it gets you out of the office and in touch with what's going on with other businesses and partners of ours, but also within the industry, getting different viewpoints. And so I've been doing a lot of that, so all good. But now we're back to normality. Sometimes it's quite nice to come back to a little bit of calm, and we'll do the podcast.
Yeah, good. So what have we got on this week's pod then? Tell me.
Well, this week I am talking bubbles, that's investment bubbles. Now, something in particular I was asked by a journalist, something in relation to bubbles and why you should care about them. I'm going to talk about smart meters and, more importantly, smart meter bullying. And it's something that's starting to creep into the headlines. I think Moneybox may even be doing something on it at some point, but smart meter bullying. And the final one is just a very short piece, because I think those other two will take a little bit longer, is on home improvements and are they worth it? So I'm talking about you're listening to this podcast and your partner is nagging you about wanting an extension, and are they worth it?
Okay, good. What are we going to start with?
Let's start with the investment bubble, because it's going to be the investment piece we're doing, but slightly longer. Now, what happened is this week I was asked by one of the national newspaper journalists about my view on investment bubbles. And in a previous podcast, we've talked about bubbles, in particular in relation to Bitcoin. So what I will do is do a quick reminder to people about what an investment bubble is and how they form. So we won't dwell on that, but just to give some context. But I was asked about what bubbles are there out there in the investment world that we should be aware of, and also how do they impact us. Now, I know you may not be an investor and may be listening to this podcast, but I will point out how an investment bubble in an asset, for example, it could be shares or something that you may not be interested in, will or could have an impact on your life anyway. So, investment bubbles, what are they? They're typically where an asset becomes overpriced, but where the price of that asset can't be explained by fundamentals, like economic fundamentals, and the price certainly can't be sustained by it. Now, more recently, if we use the Bitcoin analogy, because it's one that people have probably read about in the paper. Now, the bubble phase it's meant to be like if you blow a bubble when you're a kid and you're blowing them up and you're drinking your milk and you're blowing down the straw, and you're not meant to be doing that. And then you sort of blow the bubble and eventually it bursts. That is what investment bubbles do. But they have distinct phases. So just to give people a quick reminder, what tends to happen is there are 4 phases that have been identified by academics. They don't always follow this pattern exactly, but what happens early doors, there'll be some pioneers, early adopters of whatever the trend is, be it the tulips back in, I forget which century that it happened, the South Sea shares that caught out Newton. There'll be people who get into the trend and the price starts going up, and for want of a better word, they're probably the smart money. Then you get to the next phase where you start getting the big boys come in, some of the institutions. In the modern world, that would be the investment banks, and the awareness of this particular asset or this particular share, whatever it is, starts becoming a little bit more mainstream, and they start pumping money into it. This is typically the point in the modern day world where the media also starts getting on the bandwagon and starts talking about this asset, and we start becoming a bit more aware. Then the price here, there will be fluctuations. It's not just a one-way linear line upwards. There'll be peaks, there'll be troughs, there'll be crashes almost in price along the way, but the trend will start to be picking up. But then you get to the third phase, which is what they call mania, which is where everybody goes mental and everyone wants to have a piece of whatever it is. So in recent times, Bitcoin, so that means the general public, that's when the public weighed in. So this is when the growth of the price is almost going exponential. It's just taken off and everyone's piling in, everyone wants a piece of it. They don't really understand it, but they know they've got the fear of missing out. FOMO, as they call it. And then you get to that point where everyone piles in, probably some of the smart money and the institutions have pulled out, and then the bubble pops, and there's lots of people who bought in at the top nursing huge losses, which tends to be the public. And then you have a massive blow-off phase, they call it, where the price plummets, probably back to either where it was before the whole process started at the very, very beginning, or below. Now, that is a bubble. Now, how or why they form is partly because of speculation and in essentially greed. Everyone's trying to find the next big thing. So where are the bubbles in the world today? Now, cryptocurrency, so Bitcoin was a good example. Now, I've talked in the past about the taxi driver indicator or the hairdresser indicator, where I say that if you go to get your hair cut or you get in a taxi and they start talking about something like Bitcoin, you know that we're probably getting to the point where we're getting into a bit of a bubble, that may be a warning sign. Now, I told you, I think I said recently, I went to a party, and somebody there who wouldn't even be vaguely interested in a savings account was asking me about Bitcoin because a member of his football team was investing in it, and was it a good idea? Funnily enough, that was the peak of the market. It was that night almost. No. And so it's just a rough idea that's what starts to happen. Now, the problem with bubbles is they're great things to look at and try and appear clever, go, that was a bubble. But when you're in them, it's not very easy to identify them because there are lots of almost traps along the way. So there'll be a point where people go, oh, we're at peak Bitcoin and we're in a bubble. But we might not be. It might be one of the really early phases because the general public weren't en masse in Bitcoin. Do you see where I'm coming from? So it's only with hindsight, once it pops, once it collapses, that we can look back at the world. Like when Sir Isaac Newton got caught up in one and lost a lot of money. It's only then you can look back and people, with hindsight, almost mock anyone who got involved, which is not the right thing to do. But that's the wonders of hindsight. So in the world today, we probably have some in some of the cryptocurrencies. Another one potentially is the stock market, particularly in America. Now, obviously prices were at all-time highs. We've had a pullback. But one way of judging that is to use a valuation metric, which one of them is by using price to earnings. They take the price of a share and the earnings potential. Normally it's the forward earnings in the next year or two, and that gives you a metric. So it's like a fraction. You divide one by the other, and it gives you a number. So if the price is really high for the earnings the company's going to produce, you're going to get a big number, and that's not great. So over history, what can happen is you get a steer for what is a good PE number, they call it, a good valuation metric. There is another version which is called CAPE, which is the cyclically adjusted price earnings indicator, which was one that was created probably, I don't know, in the last 20 odd years, I think it was. But what they do is they looked at the earnings in the past. Because the one problem about looking at earnings in the future is that, I mean, you could sit there and say that money to the masses is going to make X amount of money. There's no proof or guarantee it will happen. But if you looked at what you've done in the past, that's a better indicator, and averaging out, smoothing it out, what might happen going forward. So on those metrics, the US stock market is massively expensive. And we were at levels until recently it's pulled back a bit, but heading towards .com boom time, which eventually popped. Now, technology stocks are definitely in the potential area of a bubble, although the difference between now and the .com era is when we had some of the, I suppose, last minute .com, they were around in those days, but some of the big tech companies back then, they weren't making any money. Now, Facebook and people like Amazon, they make money hand over fist. They're huge. Facebook in particular is hugely profitable. So there are reasons why their price is more elevated or maybe more justifiable, but there's no denying the tech stocks have just pretty much gone upwards, but at an accelerating rate for a very long time. So, well, certainly in the last few years, and driven the stock market in America, because don't forget, they're a bigger and bigger portion now, because they have been growing so fast and their price has been rising. They're a bigger portion of the index in America, and back to the levels that we saw at the .com level. So that was about 25% of the S&P are tech stocks. So there's a bit of a bubble forming. Now, not all bubbles have to be quite as spectacular as something like what people were claiming Bitcoin was doing. So where the price was going up like 1,000% in a year. Now, they don't have to be like that. They can probably form in a little bit of a, still very quickly, but a little bit more stealth-like manner. Now, another one I'll throw out there is the UK's housing market, but particularly London. So some of the prime London property prices have been going up at an astronomical rate. Anybody who lives in the southeast will know that. But some of that was driven by foreign investment. So people over in places like China were buying property for cash. And there was a quote I saw somewhere where somebody likened investing in the London housing market as akin to putting your money in a Swiss bank account. So basically, it was safe and you almost guaranteed some form of return. And that were people who were wealthy were saying that. Now, that was just a bit of a mantra, but you can see why the bubbles form. People think, well, do you know what, buy a very expensive house in a very expensive part of London and the price will only go upwards. Now, other areas have had bubbles. There's been property bubbles in Europe. There's one in China that's caused concern. But other bubbles potentially are in corporate debt, so bonds, and in particular in China there's been an equivalent in the what they call the shadow banking sector, the debt that people are taking on that isn't really shown on the official figures. So debt is a bit of a bubble as well. So as consumers there is a bit of a debt bubble. It doesn't seem to be sustainable. Now, why do these bubbles exist? The ones in particular that I pointed out. Now, some of them, it can be laid at the door of the global central banks. So we're talking the Bank of England, we're talking the America's US Federal Reserve. Because when we had the financial crisis, when they thought the world was going to end, the financial system was going to collapse, we're going to go into the worst recession ever, they started printing money via quantitative easing, so QE, and putting interest rates low. Now, quite simply what that does, they print money electronically, so make it out of thin air, buy bonds, so the safe, low-risk stuff from banks. So they create an artificial buyer in that market, so it drives the price up of those. The banks get cash, therefore they go and do something with it, which was meant to either lend, but they probably do something more risky with it. Lower interest rates also encourage ordinary people to take their money out of savings and try and take on more risk to get a better return, so they start investing in shares, etc. So it means that it encourages riskier behaviour, and so the money finds itself into assets which are driven up in price. So that's why bond markets have been they've been in a bull market for years before QE, but they are in a bit of a bubble, and that will pop at some point. So people may seem strange. They always think bubbles exist in only the very, very high risk assets out there. So to wrap this piece up, what are the dangers for people? Well, of course, if a bubble bursts and you're in it and you've got in at the top, then that's obviously going to be a danger. And for the general public, that's a problem, because they're normally the ones that are left holding the baby, as it were, when these things burst. The other thing that I would say is it breeds overconfidence, because one sign of a bubble is when normal armchair investors look a hell of a lot smarter than their professional peers. So when you've got the professional investors who may have bailed out or something or not be buying a particular asset, and the retail investors, so they're the armchair investors, are making money hand over fist by buying something because the price is going through the roof. Sometimes when they look particularly clever and the professionals look particularly stupid as a result, that can be a sign that there's a bubble. And that overconfidence can be taken and they think they're invincible and therefore go and invest in other assets. Because people, if you've been very successful investing in Bitcoin, you're probably going to go invest in other, even more risky assets. And there's been a lot of people who are very smug. If you saw social media going on about how well they've done in Bitcoin, funnily enough, they're not really talking about it so much now, because the price went from 20,000 to about 7,000 in a matter of weeks. Now, the other thing I would mention is that bubbles tend to be correlated. Now, the bonds and equities tend to move in unrelated. They're not correlated. They tend not to do the same thing, which is why they're good at diversifying portfolios. But what's happened is with QE, where they've driven up the prices of both, they started to move in the same way because there's been huge demand for bonds from central banks. There's been huge demand from normal investors for equity, so they've both risen at the same time. So what happens is you tend to get bubbles that can correlate with other assets. They become almost interlinked in a way. So when one bursts, the fallout of that, the panic out of that, will therefore filter into other areas. So let's imagine if the bond market suddenly collapsed. It's akin to you being stood at the top floor of a skyscraper and there's an earthquake at the bottom. Now, it's going to be pretty bad on the bottom floors, but trust me, in an earthquake you won't want to stand at the top floor of one of the tallest buildings because it'll be swaying all over the place. So it's like that. So just because the epicenter is not where you're stood, the effects can be amplified where you actually are as a result. Before we finish this piece, the other final thing is that a lot of bubbles, when they burst, they've preceded some of the worst recessions we've ever had. So if you think about the Great Depression in I think it was the 1920s in America, it was 1929, that was preceded by a huge blowout in the stock market. And also the financial crisis, we had a recession after that. So if you're interested in bubbles, you want to know if there are any more bubbles out there, there are, bizarrely, websites who do just talk about the bubbles in assets. One of them is called thebubblebubble.com. It is American. It's a little bit doom and gloom. I don't have a lot of time for people who just bang on about bubbles all that are out there. I think a lot of us can see them and appreciate them, but you and I, Andy, could bang on about the world's going to end, and eventually we'll be proven right if we say it for long enough. And that's what these people have been doing for probably 7-8 years with the equity market, and have sat on the sidelines and they get very angry. They start to appear like the guy when you go down the high street who's standing there with his Bible preaching that we're all going to go to hell. It starts feeling a little bit like that. And of course the bubbles will burst. We ought to be aware of that, but I think you've got to be a little bit pragmatic as well and just manage risk. So there we go. Bubbles, bubbles, bubbles. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers, and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, Damien, smart meters. We've mentioned smart meters before and why you would get them and why potentially they could be a good thing for people, but there seems to be a slightly negative side. Certainly the word bullying doesn't sound good. Smart meters and bullying, what have we got?
Right. A while ago, I did a podcast about smart meters and whether I would get one of the new smart meters that comes out, because I don't have a smart meter at present. And if you didn't listen to the podcast, the upshot was that I said no. And the reason I said no is because the first generation of smart meters that are out now, there is a second generation coming soon, but the current version, they have their limitations, and one of the big limitations is that they tend to work or be specific to the provider. So different providers have different meters, and what it means, you may have a smart meter installed, but when you switch energy, as we all should switch energy every year or so to keep our bills lower, that meter won't work, and therefore you have to get a new one installed. So the next generation will be able to work with any provider. You have one smart meter installed, and then when you move, it just works. And that's what we want. If you want technology, you don't want technology that is going to cause you a headache. And the idea is that I didn't want a smart meter. I wasn't convincing the world not to do it, but there are definitely cons. Now, people may not realise, I mean, Andy, are you being badgered about getting the smart meter, or do you already have a smart meter?
I don't have a smart meter, and I have to say I haven't been badgered. I haven't been getting phone calls, emails, letters from providers. But I did use a service called Flipper recently that we actually mentioned on the podcast, and on the back of that I went and used it. And they basically handle all my affairs for me. So to be honest, all of the confirmations, all of the updates actually go through my inbox straight into their inbox, and they deal with it all. So it may well be that I am being badgered, but they're kind of handling it for me.
Yeah, because that Flipper service Andy talked about, you go back and find the podcast episode that was quite interesting. Andy, if you can remember it, we'll put it in the notes of this podcast, because obviously you've benefited from it. But I've been badgered. I'm being hounded about this smart meter, and it's doing my head in, because they are emailing me, it feels like daily, about getting a book of your smart meter appointment. It is free. I've had people try and ring me, and it's relentless. And I had a phone call with a guy the other day who said, "Oh, you want a smart meter?" And I said, "No, I don't want a smart meter," and explained my reasons. And he flat out told me it wasn't true, which was a basic lie. And anyway, he was trying to say, "No, we need to do it." So I was just like, look, I'm not interested in the smart meter. Just put me down as a non-smart meter person. Now, to give people context, what's happening is the energy companies have to install 50 million smart meters by 2020. And at the moment, they've only done 11 million of them. So that means that every household, you're getting a free smart meter. And you might think, well, what's wrong with that? There's nothing fundamentally wrong. I'm just waiting for the next phase because they'll be better. But for the energy companies, the reason they're bothered is because if they don't fit a meter to their targets, they could potentially get a fine of 10% of their sales worldwide, and that's going to amount to billions. So now you can understand why they are like dogs with a bone trying to get smart meters installed. Now, that 2020 deadline is not very far away. It's 2 years away, and if you work back the numbers, it does mean that they've got to fit 24 smart meters every minute between now and then. That's a lot, and I know it's 24 across the UK, but they've got their work cut out. So what's happened, it's basically been a campaign that's been run by one or two newspapers, and it's come out in the news. The energy companies are using very aggressive bullying tactics to try and, I would say, con people or maybe trick people into having a smart meter when they didn't actually want one. So I'm going to tell you quickly some of the tricks so you don't fall foul of them. One of them is they've been booking installation dates with people, saying, right, here's your date for people coming around to install your smart meter. Now, it is optional. You don't have to have one. There's no compulsion. It's not a legal requirement. And so people will go, okay, they're having it done, but they may not want to. And the reason they're doing it is, yes, it's good for your energy bill, and it means you don't have to keep doing meter readings. So there are positives, definitely. But the reason they're doing it is because they're worried about getting fined. Now, the barrage of emails that people are getting, which I've just complained about, some of them are claiming that your old meter is being phased out. Now, nothing's being phased out. They still exist. They're not going anywhere. But using terminology of, like, phased out gives people the impression, it's very clever use of English, that actually, do you know what, I have to change this without telling you that you do. They're using terminology that encourages people, but you don't have to. They also are using tricks to give preferential rates to people who have smart meters in terms of energy deals. And some of the companies are when you switch across to their cheap deal. So you've gone on, done your research, you're loving the price, you flip over or whatever you're going to do, switch to the new provider. They're then being told 6 months into the deal that, yeah, hold on, the deal that we were going to give you was on the proviso that you had to have a smart meter installed within 6 months. And of course, for some people, it's a privacy thing. In the world where Facebook and everybody is taking all our data, some people don't want their energy usage being beamed remotely to their energy provider. Why, I'm not sure what the upset about that is, but...
Because they've got a cannabis farm in their roof, probably.
Well, there you go. That's probably why Andy has just uncovered it. So the old man who was pictured in the Daily Mail who was moaning about it is actually the next Pablo Escobar.
Yeah. Actually, talking about cannabis farms in roofs, sorry it's a bit of a tangent, but it's a real quick one. Do you know the recent spate of cold weather that we had?
Yeah.
Did you hear that there were lots of minor sort of criminals and small gangs that got caught out because where the snow wasn't settling on the roofs of certain houses, they managed to realise that there was cannabis farms in the loft space and loads of people got arrested on the back of it. I think it's brilliant.
Is that true?
It's actually true.
Because I always thought those sorts of things were like urban myths, but that's brilliant. I mean, I can't remember if I told the story on the podcast where a friend of mine was he had a landlord and he was renting out places and he rented out himself. Maybe I'll tell the full story one day. Cut a very long story short, he rocked up there one day and there was no one in there and they turned the entire house into a cannabis farm. And the garden, when he told me, we're very good friends, I was in pieces about it, but they dug the garden and put the garden inside the house. He showed me photos of it. The garden, there was like a soil up to like a couple of inches depth throughout the entire ground floor. There was no soil really in the garden, so to speak of. And they'd gone through the walls. They'd actually smashed through walls and put those ventilation, those metal tubings, all the way up into took it out the chimney. And they'd done it all through the house. They'd ripped through the wirings and pulled it all down with big lamps coming down. And I said to him, didn't the neighbour, because it was a terraced house, didn't the neighbours not notice that the guys never opened their window, and also they seemed to be just demolishing the house from the inside out? And he said no. I think it was probably the kind of place where people didn't want to keep themselves to themselves, but it must have stunk. It must have done. Anyway, he showed me images. Oh yeah, I'll maybe tell the full story one day. It was funny, but it did a lot of damage. The insurers paid out. I mean, I think it was about 20 grand's worth of damage to the house, wow. Which bearing in mind it was a non-furnished letting, buy to let. That's quite incredible. But the insurers paid out. Anyway, that's me done. Oh, the one final thing on that: don't let the energy providers trick you by saying that if you don't take your free smart meter installation now, that you may have to pay for it later, because that's nonsense. So up to you whether you want to have one installed. If you have, great, good luck, but I'm waiting for the next bout just because I don't want to have to do this twice.
Okay, last piece, extensions, are they worth it?
Yeah, well, this came from a piece on Money to the Masses about home improvements, and it was about how to fund home improvements. If you want me to talk about that in a future podcast, about the best ways to fund home improvements, whether it's loans, remortgaging, then let me know. Twitter, email. Andy will shout out the contact stuff at the end of the podcast. But this is just a very snippet, because we're at the end of the podcast, about whether, not how to fund home improvements, but the value of them and whether they're worth it. Because there comes a point where most people are thinking, do I just put a little extension on the side of the house, convert the loft or whatever it is? And as a man who converted his loft, so regular long-term listeners will know the pain I went through for that. As a steer, apparently the cost, we'll start with the cost, so this is cost versus benefit. The cost of home improvements and an extension is £1,000 to £1,500 per square metre. So get out your measuring tapes if you're thinking about doing something, measure the size, and that is the rough cost. So that means on a 3x5 metre extension, you're looking at about £22,500 for that extension. So is it worth it? Well, if it's adding perhaps a bedroom, it will certainly add value to your house. And if it's maybe improving something like the kitchen, it might add value. But particularly if you add a room, it adds value in a bedroom. Now, research has shown or claims that typically an extension of some kind will add up to 11.2%, so very precise, 11.2% to the price of your house. So work the maths backwards. If you're going to do an extension, then your house is worth £250,000, say, then by the maths that we've just done, then it will probably actually be cost effective. So there you go. Bit of value at the end, a bit of building work.
Good, and obviously there's those people that just don't have the choice, isn't it? They're not doing it for an investment, they're doing it because they've had baby number 7 or 8 and they need that extra bedroom. Baby number 7 or 8. Who has 8 babies? Well, some people, I suppose.
Yeah,
actually, my cousin's got 7 children.
Have they?
Yeah.
She?
He's got... he had 5 boys, and then they were desperate to have a girl. So they eventually had a girl at number 6, and we thought that was it. And then number 7 popped out last year. So there we go.
What? And was that a boy as well?
That was a girl as well. Yeah, 5 boys.
Oh, a
2
girl.
girls.
See, that was the thing. I never get that thing of keep going until you get a girl or the boy, because I just know so many people who you look at their family and you think, yep, 3 girls. Right, I think you were going for the boy, weren't you? And they say they weren't, and you sit there and think, yeah, you were.
I would like to hope that they don't get involved with gambling at all, because they're the sort of people that would just keep doubling their bets until they hit red, or keep flipping the coin until they hit tails. If you've got lots of children, don't gamble.
That's good advice, Andy. It's good advice. So, we're done for this week. I think, as ever, Andy will give you the contact details. Please leave a review. We will read them out as we do these days. So please help us get up that iTunes chart. And if you've got any questions or topic suggestions, the last few weeks we've done a lot of reader-inspired content.
Good. And as Damien said, if you want to get in touch, please do so. Twitter, it's at Money to the Masses with a number 2, and you can get in touch via email if you like, podcast@moneytothemasses.com, or straight into Damien's inbox. I'll let you into a secret, they both go through to him. It is Damien@moneytothemasses.com, and that's Damien with an IE. Some people assume it's IA, but it is IE, Damien. There we go, we're done. Enjoyed that this week.
Yeah, I did. It was an interesting one. Nice mix of different things there.
And so that's it. We'll see you next week.
Till next week, Andy.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.